Welcome back to Financial Focus Radio. Thank you for joining us. My name's Tyler Simones. That guy over there is Josh Fenili. We're partners at Northwest Quadrant Wealth Management here in the, thankfully not smoky anymore, Pacific Northwest. If you want to be part of our show, give us a call, 877-670-7117. Or you can always go to our website, financialfocusradio.com. I'm going to remind people one last time to go on Netflix this weekend and watch The Social Dilemma. If you want to know what's going on in the world and why things are going on the way they are in the world, this explains a lot about what's going on the internet, especially with social media companies. And so if you care about your consumption of this stuff and the effect that it's having on you, and especially your kids and grandkids, you definitely want to go and watch The Social Dilemma. It hopefully will change some of your behavior. I know it's going to. In my house, my kids are not happy about it. According to the Bureau of Labor Statistics, for every $1 spent for wages and salaries in the private sector as of June of this year, employers spend an additional 45 cents on benefits, including paid leave, insurance, retirement plans, and legally required benefits. Average private sector compensation is $28.24 an hour, while the cost of benefits average an additional $12.75 an hour. I think oftentimes that is overlooked. I know, in our business, that cost is not huge, but the bigger the business, the bigger that cost can be. And I think a lot of times employees overlook that benefit.
Well, and when you look at wage growth statistics, it's difficult to compensate for that and normalize it back to.
Yeah, when you look at how much health insurance has gone up since Obamacare came into law, the employer is bearing a lot of that cost. Of course, you are employees, but the employer is bearing a lot of that. And so, that doesn't mean they're not cutting your wage equivalent to how much their cost is going up for health insurance. And so you are seeing increases in your compensation. It's just not your actual take-home pay. But the cost of having you as an employee for businesses keeps going up, and that is tough. One of the other things is we've seen borrowing. So the U.S. consumer is saving money like we've never seen. The U.S. consumer has saved $12.5 trillion from the end of March to the end of August, the most ever over that short period of time, and it's being done across income spectrums. But where we're not seeing saving, where we're actually seeing the opposite, we're seeing unbelievable levels of borrowing is in corporate America.
I think your figure is off. 1.2 trillion.
No, it was $12.5 trillion, according to the Wall Street Journal.
Oh, really? Because I thought because it was supposed to be $4 trillion annualized based on.
Maybe you're right. That $12.5 trillion seems like a lot of money.
Yeah, because that'd be like more than 50% of GDP.
Yeah, you're right.
Yeah.
Anyways, it's a lot of money.
No, and
Jeff Bezos was half of it.
Arguably, like the increase in the personal savings rate is potentially impactful to equity prices.
Potentially.
Yeah.
But where we're not seeing it, and we think that it's going to have an impact probably in the next year, early part of next year, is corporate America is borrowing money like drunken sailors. And so corporate debt has just exploded. And if demand doesn't come back and the Fed doesn't buy their bonds and bail them out, then we could see lots of bankruptcies in 2021.
Well, debt issuance is the name of the day when you can do it.
Yeah, I guess. But at some point, you would think these zombie companies would not be able to borrow money to the extent they've been borrowing them. All right, let's talk about rebalancing your portfolio, when you should do it, how you should do it, why you should do it, all those kind of things. And then also talk about, making sure that when you look at your all of your retirement money, your non-qualified accounts, your qualified accounts, all the different places you can access money when you're retired, that you're doing it from the most tax advantageous place. Because we see people come to our office for free retirement reviews, and we say in retirement, and they're taking distributions, and we say, well, why are you taking money from this account? You'd save a bunch of taxes if you took it from this account, or why don't you delay Social Security and take more money from your retirement account so your Social Security check goes up? All those kind of things people don't think about enough, but they have a huge impact. So first thing, Josh, why don't you explain what rebalancing is first, and then sort of the math behind why people should be doing it and how they should do it.
Rebalancing is just the process of bringing your asset allocation back to the predetermined levels. And, we talked in the second segment of the show about how to come to an asset allocation and what an asset allocation actually is. Rebalancing just entails actually selling off appreciated assets and buying back depreciating ones. And
so selling high, buying low.
Yeah, and we look at it and we talk about it a ton on the show because we talk about it in client reviews. We talk about it with potential prospects, and there's so much that goes into it that is an actual value add. The last time we rebalanced portfolios was in March, and it's a rules-based process for us. We do what's called a combination of really threshold-based, so we look for targets, but it's also time-based, and we don't want Vanguard shows that rebalancing essentially between 12 and 18 months is the best timing in terms of adding to risk-adjusted return over the long run. You don't want to rebalance too frequently because you want to let your winners run, and so we kind of combine the threshold, meaning, stocks have sold off now 10%, and we have specific thresholds that are rules-based for when we actually are going to rebalance. Many people have a really difficult time executing a rebalance into a falling market.
So the advantage for all of you people that are emotional investors is if you employ a rule-based investing approach, whether it be based on time or tolerance is what we think you should do. So when your tolerance gets out of whack because either markets are up too much or down a bunch, and you do it based on rules, you take the emotion out of it, and it's the greatest risk management tool that you can apply.
Divorce yourself emotionally from the process is our argument.
Everybody out there needs a risk management tool, and if you do a rules-based rebalancing, that's your risk management tool as long as you follow your rules and you take your emotion out of it. And everybody can do it. In fact, if you have a 401k plan, it's automated within almost every 401k where it's an option that you can just call up or go online and see rebalance option, and you can do it. And so, from a risk management perspective, but also a return perspective over time, it's really important to magnify returns, but also protect your gains.
And the last year and a half in equity markets, you look at 2019 and the ripping markets provided an opportune time to rebalance out of equities and buy back safe assets. And then conversely, 3 months later, in the Ides of March, really, you had the opportunity to do the opposite. And we did both.
We did our rebalance in December of November of 19 because markets had done so well. So we sold stock, bought bonds, and then in March, because the market had sold off so much, on March 19th, the market bottom on the 23rd. We rebalanced on the 19th, not because we knew we were close to the bottom, because our rules had been hit.
And it's a mechanical, unemotional process, and that's exactly what it should be.
And so for all we know based on the data that all of you out there listening are emotional people and have a very hard time doing the right thing with your money when it's very difficult to do it, when there's blood in the streets or when markets are ripping. Because it matters on both sides. It matters when markets are bad and it matters when markets are good. And so if you can just either write your rules down or put them into your portfolio as automatically happening, that there's an alert that you have that comes up that says, okay, you've reached your tolerance, it's time to rebalance, and you just do it and you take your emotion out of it, your returns over time will be much better, your volatility will be lower, and it's the no-brainer way to have risk management applied to your portfolio without having to have your emotion involved.
And expanding on just the topic of rebalancing itself, but when you're a do-it-yourselfer and you're taking distributions, you're functionally rebalancing by harvesting an asset that's grown relative to everything else.
As long as you do it that way.
Yeah, and that's really difficult for people to do in practice, and that's where we feel like we add a lot of value. And
that's what Josh is talking about is if you're in distribution phase and you have a total return portfolio, which is what we have for our clients. When stock markets are good and people are taking distributions, we're selling the stock part of their portfolio, so it keeps their asset allocation the same. But when markets are really bad on the stock side and bonds are doing well, that's where we go to get cash.
And the reason we do that is you have less of an opportunity cost over time.
Yeah, and so we know that do-it-yourselfers aren't thinking that same way. And so rebalancing can be a really good tool if you do it on a rules-based platform that takes your emotion out of it. Because we all know the worst enemy to all investors, including professional investors like Josh and I, is emotion. And if you can eliminate emotion by adding rules, then you're going to be successful. So rules-based investing around rebalancing is vitally, vitally important. All right, if you want to take us up on a free retirement review and we can talk some more about rebalancing, rules-based investing, any of those kind of things, call our office to get that scheduled. That number is 800-743-0988, or go to our website, northwestquadrantwealth.com. When we come back, we're going to take some of your email questions, so stick around.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial.